What if the secret to building wealth was simply doing less? Not picking the right stocks, not timing the market, not hiring an expensive advisor, just doing less. That's the radical idea at the heart of one of the most important investing books ever written, The Little Book of Common Sense Investing by John C. Bogle. Bogle was the founder of Vanguard, one of the largest investment companies in the world. And in this book, he makes one argument, clearly and relentlessly, from the first page to the last. Most of what Wall Street sells you destroys your wealth, and there is a better way. Let's start with a simple truth that almost no one in the financial industry wants you to know. Every dollar earned in the stock market is earned by someone, and the total return earned by all investors as a group equals the total return of the market itself. No more, no less. That's just math. So if half of investors beat the market, the other half must underperform it. It's a zero-sum game. But here's where it gets important. Before costs, half of investors beat the market. After costs, almost none of them do, because every fund charges fees, every trade generates taxes, every middleman takes a cut, and all of those costs come directly out of your return. Bogle gives us a formula so simple it fits on a napkin. Market return minus costs equals your return. If the market grows at 7% a year and your fund charges 1.5%, you take home 5.5%. That gap doesn't sound like much, but let it run for 40 years. $10,000 growing at 7% becomes nearly $150,000. That same $10,000 growing at 5.5% becomes just $83,000. You didn't make a single bad investment. You just paid too much in fees, and it cost you $66,000. Bogle calls this the tyranny of compounding costs, and once you see it, you cannot unsee it. So the obvious question is, can't a smart fund manager just beat the market and make up for those costs? The data says no, and it says it loudly. Over any 15-year period, roughly 85 to 90% of actively managed funds underperform their benchmark index after fees, not just slightly, meaningfully. And the small number that do outperform in one period rarely repeated in the next. Bogle identifies 3 reasons why. First, costs. Active funds charge between 1 and 2% per year, sometimes more. That is an enormous hurdle to clear before you generate any real excess return. Second, reversion to the mean. When a fund has a great run, it attracts billions in new money. More money makes it harder to move nimbly and find the same opportunities. Last year's winner almost always becomes this decade's average. Third, the market is smart. Millions of professional investors analyze the same companies, read the same reports, model the same data. Any information advantage disappears almost instantly. It is genuinely difficult to find consistent edge in a market where everyone is competing at the highest level. The sad irony is this: the more you pay for investment advice, the less you tend to receive. So what does Bogle recommend instead? Own everything. A broad market index fund buys a tiny slice of every publicly traded company in the market. When businesses grow, you grow. When dividends are paid, you receive them. You never need to pick the right stock because you own all of them. And because an index fund requires no analysts, no expensive research, and almost no trading, its costs are minimal. Some index funds today charge as little as 0.03% per year. That is $3 on every $10,000 you invest. Compare that to the typical active fund, which might charge 1.25%, $125 on that same $10,000. Bogle gives us this image that I find unforgettable. He says, don't look for the needle in the haystack. Just buy the haystack. You don't need to predict which company will be the next great success story. You just need to own a piece of all of them. The winners will carry the whole basket forward. The 4 advantages Bogle highlights are diversification, low cost, tax efficiency, and simplicity. No research, no guessing, no stress, just ownership. Now let's talk about what this actually looks like in practice, because Bogle is not vague about this. His prescription for the individual investor is almost shockingly simple. Step 1, start early. Time is your most powerful ally. A 25-year-old who invests $200 a month will almost certainly end up wealthier than a 40-year-old investing $500 a month. Not because of skill, but because of compounding. The earlier you begin, the more years your money has to multiply. Step 2, invest regularly no matter what. This is called dollar cost averaging. When markets fall, your regular contribution buys more shares at lower prices. When markets rise, you buy fewer shares, but the ones you already own are worth more. Over time, this smooths out volatility and removes the impossible task of trying to time the market. Step 3, never stop. This is where Bogle is most insistent. The single biggest mistake individual investors make is selling when the market drops. Markets crash. They always have. But they have also always recovered. The investors who panic and sell lock in their losses permanently. The investors who hold through the storm, who stay the course in Bogle's words, are the ones who come out ahead. Stay the course. He says it over and over. It is not a platitude, it is the entire strategy. Bogle ends this book with something almost philosophical, and I think it's the most important part. He reminds us what stocks actually are. They are not ticker symbols. They are not numbers on a screen. They are ownership stakes in real companies, companies that make products people use, hire people who spend money, generate profits that grow over time. When you buy an index fund, you are not gambling. You are not speculating. You are becoming a part owner of the economy itself. And over the long arc of history, through wars, recessions, crashes, crises, that economy has grown. Human ingenuity has compounded. Businesses have created value, and patient investors who simply own the market have been rewarded. The daily noise, the headlines, the predictions, the fear, is a distraction from a simple underlying truth. Productive enterprise over time creates wealth. The only question is whether you will capture your fair share of it, or hand most of it to Wall Street in fees. Bogle's answer is clear. Buy a low-cost, broadly diversified index fund. Contribute to it consistently. Reinvest your dividends. Ignore the noise, and never ever sell in a panic. Do that, and over a lifetime you will almost certainly outperform the vast majority of professional investors. Not because you worked harder, not because you were smarter, but because you were wiser. And wisdom in investing is knowing when to do nothing